Have you ever wondered how professional investors analyze stocks? What makes hedge funds, investment banks, and fund managers choose certain stocks over others? In this video, I'll take you through the exact step-by-step framework used by finance professionals to analyze stocks. We'll cover fundamental valuation models, technical indicators, macroeconomic factors, and even a real-world stock analysis case study. By the end of this video, you'll know how to evaluate any stock like a professional investor. Let's dive in. Before investing in any stock, you need to understand its intrinsic value. Professionals use multiple valuation techniques to determine whether a stock is overvalued, undervalued, or fairly priced. Let's start with the most important methods. 1. Fundamental analysis. The core of stock valuation, P/E ratio. Price to earnings. Formula. Stock price divided by earnings per share. This tells us how much investors are willing to pay for every dollar of earnings. A high P/E means the stock is priced for high growth, while a low P/E suggests the stock is undervalued or facing risks. EV/EBITDA, enterprise value to EBITDA. This is widely used in M&A transactions and private equity deals. Why is it better than P/E? Because it includes debt, giving a full picture of the company's value. EV/revenue, enterprise value to revenue. Commonly used for high-growth tech companies like Tesla and Nvidia. A lower ratio means a company is trading at a discount compared to its sales. Discounted cash flow, DCF analysis. This is the gold standard for professional valuation. It estimates a company's intrinsic value based on its future expected cash flows. Uses the weighted average cost of capital, or WACC, to discount future earnings. Example: if Tesla's DCF fair value is $200, but it's trading at $250, it may be overvalued. Key takeaway: no single metric tells the full story. Professionals combine multiple valuation methods to get the full picture. Fundamental analysis tells us what stock to buy, but technical analysis tells us when to buy it. 2. Key technical indicators for entry and exit. Moving averages, 50-day and 200-day. The golden cross happens when the 50-day moving average crosses above the 200-day moving average. This is bullish and often signals a strong uptrend. The death cross is the opposite, when the 50-day falls below the 200-day, signaling weakness. RSI, Relative Strength Index. RSI above 70 equal overbought. Possible pullback coming. RSI below 30 equals oversold. Potential buying opportunity. Support and resistance levels. Support. The price level where a stock consistently finds buyers. Resistance. The price level where a stock struggles to break higher. Buying at strong support levels increases your risk-reward ratio. Key. Takeaway. Technical analysis helps you time your entry to maximize profit. Even if a stock has strong fundamentals, external macroeconomic factors can significantly impact its price. 3. Economic influences on stocks. Interest rates and inflation. Higher interest rates reduce stock valuations because the cost of capital increases. Tech stocks suffered in 2022 due to rising interest rates. GDP growth and recession risks. Strong GDP growth benefits. Cyclical stocks like tech and consumer discretionary. In a weak economy, defensive sectors like healthcare and utilities perform better. 4. Political and regulatory risks. Government regulations. New rules for big tech, AI, and EV subsidies can impact stock prices. Example: Tesla's stock price depends heavily on government EV incentives. Geopolitical risks. U.S.-China trade tensions affect companies like Apple and Nvidia. Oil prices and war conflicts can cause global market uncertainty. Key takeaway: macroeconomic and political factors can override fundamentals. Always watch the big picture. Now, let's apply everything we've learned to a real-world stock. Example: Nvidia, NVDA, stock analysis, fundamental valuation. PE ratio, 80. Expensive compared to sector average. EV, EBITDA, 50. High valuation, driven by AI growth. DCF model. Intrinsic value estimated at $600 versus current price of $800. Technical analysis. RSI at 75, overbought territory. Support level, $700, possible buying opportunity on a dip. Macro factors. AI boom. Nvidia benefits massively from AI adoption. U.S.-China relations. Export restrictions could impact future growth. Final conclusion: Nvidia is a strong long-term play, but may be overvalued short-term. Now that you know how to analyze stocks like a professional, I want to hear from you. What stock should I analyze next? Drop a comment below. Want more investing insights? Subscribe to Banking and Finance Academy for weekly finance breakdowns. Check out my favorite stock analysis